Tyler Crow, you and I are both a fan of dividend stocks. And if we can find a high yield stock that we really like, that's setting itself apart, that's not just a yield trap waiting to snap on our portfolios, we're going to buy it. You ready to talk about a couple of high yield dividend stocks that we have on our watch list that we're getting ready to buy more of?
I've been staring at mine for like months now, trying to find the right time to buy. So yeah, let's hash this out. Maybe you can give me some thoughts on it.
You got it. Sounds like a great idea to me. I'm Jason Hall. This is Investing Unscripted. Tyler and I are going to talk about those two stocks. This video is sponsored by The Motley Fool. If you go check out our special link, it's fool.com/unscripted. This video is going to get even 5 times more valuable for you. Tyler and I have two great stock ideas for you. Go to that link, fool.com/unscripted. The Motley Fool is going to give you its 10 best stocks to buy right now. Watch one video, go to one link. That's 12 great stock ideas. It's worth your time to check it out. Okay, Tyler, you go first.
All right. So as we normally do, this is Tyler Crow's Obscure Stock Quarterly.
Obscure
Ternium.
Stock Weekly, pal. Who are you kidding?
That's true. So we're going to talk about Ternium. Ternium is a steel company that focuses on Latin America. It's actually, if we just say the Western Hemisphere, they're the second or third largest, depending on how you want to measure actual steel output, somewhere between Nucor and Cleveland Cliffs in terms of actual output. So here's the reason that I have been circling this one for a long time. It says Argentinian, but the more than half of its business is actually in Mexico. And this is where things start to look really attractive to me. One of the things that we have heard numerous stories over and over again has been kind of the booming economic output of Mexico as of late. Nearshoring has been a major trend in terms of manufacturing capacity. So a lot of places that were either in China or somewhere in Southeast Asia that were really disrupted by the pandemic or now starting to look at things like tariffs or things like that are moving to Mexico. And it's been an absolute economic boom. They really, started off as like a very strong in the automotive manufacturing, but especially in terms of components. But we're seeing a larger and larger share of automotive manufacturing go there, and on top of that, just industrial output in general. And because of that, there's lots of construction and lots of steel use. And that's where Ternium really comes in as one of the premier suppliers of steel in Mexico. Right now, one of their major capital projects is an expansion of its Nuevo Leon, Monterrey area, Mexico facility. It's going to drastically increase its output, not just in kind of like cheap construction steel, but also like automotive grade steel. So there's a lot of catalysts going on with this business in general. And, I think this is going to be a multi-year sort of upcycle we're going to see in terms of industrial output in Mexico and Latin America in general. And on top of that, we have a business that's, it's a little cyclical because it's a steel industry. Margins are okay, not great, more or less kind of on par with what we see with North American steel producers, a little bit closer to the Nucor sort of margins than like a Cleveland Cliffs or the other traditional blast furnaces. And what is appealing to me is right now it's trading for 0.6 times book value. It's not over leveraged. It has pretty decent debt profile and right now has a dividend yield of 7.7%. Now, to be fair, it's a variable dividend, but it's been churning out such sufficient cash that as of late, that it can pay out pretty generous dividends right now. And look, I know there's a chance that we could see an economic decline, but with a book value like that, I think there's a pretty good I would call that a relatively decent margin of safety in terms of what I'll be getting out of this business. And with a yield like that, I think I can get a pretty decent return.
Yeah, it's a great combination, right? So you have the margin of safety in what you're paying that feels like protects your downside. And then you get that 7+% yield along the way. It can make it easier to be patient because you're getting some return whenever they cut those checks back to shareholders. So that's certainly a really valuable way to invest. So this is one, Tyler, you've encouraged me to dig into. Of course, the thing that concerns me is the cyclicality, right? That's always a big risk with these sorts of companies. The fear that you're investing right at the time where it seems like demand is really, really strong. And then, of course, the rug gets pulled out from underneath demand and it collapses and it takes years and you take years to recover from that. I love the Mexico story, though. Mexico and being more tied to North America in both Canada and the U.S. with the improved free trade agreements that I think really support a lot of what you're talking about. I think it's really compelling. I'm going to go in a little bit of a different direction. I'm going to stay in the US, but also move east and head overseas with Realty Income, which has a big business in the US, but also has expanded into Europe, and their acquisition of Spirit Realty Corp they made last year, they closed earlier this year, expanded their business a little bit in Europe through larger operations that Spirit Realty has there. Now, I've bought some Realty Income recently as early in April, but it continues to remain on my watch list of stocks to add more to. And I'm looking to add more of it in May, but I'm not quite ready to buy more yet. Let's talk about Realty Income's business, what it is. So it's what they call a net lease REIT. So real estate investment trust. They own the property and they have tenants that they lease it to. So the way the net lease ones work, and particularly with this business, is they're standalone properties that they lease out to tenants like fast food restaurants, experiential retail, pharmacy, Costco, other like wholesale retail. And those tenants, they pay everything, right? They pay a lease payment to Realty Income, but they're also responsible for property taxes, maintaining the property, insuring the property. They pay all of those things. So that's why it's called a net lease. And it's been a really great business. They have some really good, strong tenants, long-term relationships with them. They've delivered a lot of value over the years. But one of the reasons I'm being a little patient, it's on my watch list and I'm waiting a little longer into May before I decide whether or not I'm going to buy more or not, is because last year was a really busy year, Tyler. They did a lot of stuff. I mentioned the Spirit Realty acquisition. It's a big deal to kind of merge those businesses together, make sure they take care of all the tenants involved, have the right people. One of the ways those deals work, Tyler, is when you acquire somebody who does the same thing you do, you can get rid of a lot of their people that you already have people that are doing it, right? So that's one of the ways you save costs. And the risk, of course, is damaging relationships with your tenants. So they have to manage that really well. They've started making investments in areas that they're not experts in. They did a big deal with Digital Realty Trust to invest in some data centers. Well, data center, the way that those businesses operate, is totally different from a net lease business. So I like the fact that they partnered with somebody like Digital Realty that's one of the leaders in that space to let them be the operator, right? But you're investing in an area that you don't have expertise in. They've started stepping more into other areas that are a little different too, like their big investment in the Bellagio. They spent $900 million to become one of the owners of the property, right? Again, that's a little different than what they've done in the past. So they report earnings. I believe it's May 5th or 6th is when they report earnings. And this is a quarterly report, but it's one that I'm going to be paying a lot more attention to than other quarterly reports that I've gotten from companies like Realty Income, because I really want to have a good idea how the integration of Spirit Realty into the business is going. They closed that deal in late January. So they've had more than a quarter to kind of work through it. So I want to learn more about how that's gone, see the financial results that really kind of puts the proof to what management is saying versus what the business is doing, and also get more idea of how they're looking at their costs going forward, the dollars that they're looking to spend capital to deploy in this higher interest rate environment. Is that they've proven that they're really good at allocating capital, have very, very good credit rating, investment grade credit rating, have tons of liquidity that they have access to. And that means they can put money to work, right? But in this environment, in higher interest rates, margin of safety, we talk about that a lot, is seems to be a little thinner, right? You have to do the deals really, really well and originate really, really well when your cost of capital is higher, right? So I really am going to be paying close attention to what management says, their financial results, before I decide whether or not, even with the stock, to me, that looks like it's trading at great values compared to like the 5-year average, 10-year average, the dividend yield looks really, really attractive. But I'm going to kind of make them earn my money a little bit more before I add to my position. I think a lot of investors that maybe don't have a large exposure to this company, it still looks really attractive right now. It's just starting to become a bigger and bigger part of my portfolio. So I'm being a little more thoughtful about whether or not I'm going to give them any more money just yet, or I want to see them do a little bit better.